Okay, now see, we are going to discuss one section 55, subsection 2, clause AC. Okay, now this section talks about listed equity shares or units of equity oriented mutual funds and units of business trust. If you transfer them on a recognized stock exchange and the transfer is taking place on or after 1st April 2018, and at the time of transfer STT is also paid, and in the case of listed equity shares STT is also paid at the time of their acquisition. Okay. Now, if you transfer these assets on a recognized stock exchange as what? Long-term capital asset. As what? Long-term capital asset. Then, long-term capital gain under section 112A will be calculated. So, if the transfer take place on or after 1st April 2018, then the gain, long-term gain, will be covered under section 112A. Earlier, what used to happen, if these type of transfers used to take place prior to 1st April 2018, no? So prior, what did I say? Prior to 1st April 2018, if long-term capital gain was there, no? That long-term capital gain was fully exempt under a section known as 1038. There was one section earlier, 1038. In that section, this long-term gain used to get fully exempt. But with effect from 1st April 2018, meaning Finance Act 2018 amendment came. And in that year, it was decided that from now onwards, this type of long-term gain will no more be exempted. It will be taxable under a separate section 112A. So now that capital gain, the same type of long-term capital gain which was exempt earlier is now taxable. But it will be taxable under section 112A. If the transfer takes place on or after 1st April 2018. For example, in 25-26 you are selling on a recognized stock exchange, meaning you are selling on or after 2018 only, no? So meaning right now, if the transfer is made, then the transfer will result into long-term gain which will be taxable. But earlier, it was not taxable, it was exempt. Now, whenever you will calculate this long-term capital gain, at the time of calculating this capital gain, what will be the full value of consideration? Full value of the consideration will be the selling price. That the price at which you have sold the shares on the stock exchange. That selling price will be the full value of consideration. Minus what? Minus transfer expense. So whatever transfer expenses are there, meaning selling expenses, like brokerage, etc. you pay. Yes or no? That brokerage will be allowed as a deduction. But at the time of transfer, STT is also to be paid, no? That STT, amount of STT will not be treated as your expense. Because if you remember, I have already told you, deduction of STT will not be available while calculating capital gains. So if you are calculating this capital gain also, the deduction for STT will not be available. Only the brokerage, etc., which you have paid at the time of transfer, that will be allowed as a transfer expense. Okay. Next one, you will get what? Net consideration. Now, out of this net consideration, you have to reduce what? Cost of acquisition. This is the part which is there in section 55 to AC. 55 to AC talks about this cost of acquisition. If these shares were acquired prior to a particular date, then what will be the cost of acquisition? So whatever cost of acquisition you are supposed to take here, that cost of acquisition will either be the actual cost or will be under section 55 to AC. Either this cost will come or this cost will come. Now after reducing this cost from the net consideration, whatever long-term capital gain will be there, that long-term capital gain will be under section 112A. This long-term capital gain up to 1,25,000. Tax on that will be nil. No tax will be charged on the first 1,25,000. And they're just giving you a lollipop right now. Why? Because earlier this gain was exempt, and immediately if we start charging the gain fully, then people will start cursing us, no? So no, we are not charging the tax on the entire gain. On the first 1,25,000 of gain, we are not charging any tax. And after that also we will charge at a very lower rate. So earlier this was 1 lakh, changed to 1,25,000 last year. And earlier, over and above 1 lakh, whatever gain was there, that was charged at a concessional rate of 10%. Last year, that rate is also changed. That rate was increased to 12.5%. Because long-term tax on long-term gain, they wanted to rationalize. They wanted to keep the tax on all the long-term gain equal, 12.5%. Whether it is long-term gain under section 112 or long-term gain under section 112A. So that long-term gain tax was reduced to 12.5%, but this was still 10%. So to bring it to 12.5%, they have brought it to 12.5%. So to compensate for the increase in the tax rate, they increased the limit also from 1 lakh to 1,25,000. Last year this amendment has come. Yes or no? 23rd July 2024. So right now what is the situation? If this type of long-term gain is there, which you are going to calculate now, up to 1,25,000, no need to pay any tax. But the excess amount of long-term capital gain, on that excess amount you have to pay tax at the rate of 12.5%. Not on the entire gain. Now this is the manner in which the gain will be calculated. So under section 112A, under section, the long-term gain will be calculated for which assets? Listed equity shares, units of equity-oriented mutual fund and units of business trust, which are transferred on a recognized stock exchange on or after 1st April 2018. At the time of transfer, the STT is paid, and in case of listed equity shares, STT is also paid at the time of acquisition. If all these conditions are fulfilled, then your asset, if the holding period of that asset is more than 12 months, then it will become long-term asset and you are going to calculate the long-term capital gain. But now that long-term capital gain will not be covered by section 112, it will be covered by a separate section 112A. How that will be calculated? Simple. You will take full value of consideration, nothing but the selling price of that asset minus the transfer expense. You will get the net consideration. But remember, while reducing the transfer expense, reduce the brokerage only and don't reduce the STT. You will take the cost of acquisition, and whenever you are taking the cost of acquisition, here also don't include STT. STT paid at the time of acquisition will not be included in the cost of acquisition also. Understanding? After reducing this, whatever amount will be there, that will be a long-term gain under section 112A. On the first 1,25,000, no need to pay any tax. On the excess amount, pay tax at the rate of 12.5%. Understood? Sure? So this is the manner of calculation. But in this, what cost you are going to take? Either the actual cost or 55 to AC. Now see, I'm going to discuss about this now. I'm going to discuss about this. Okay. Very important discussion. So now see, if such assets, if listed equity shares were acquired by the assessee, when they were acquired? Prior to, on or after? Prior to 1st of February 2018 and on or after 1st February 2018. You have to remember this date. Okay. So if you are calculating the capital gain for listed equity shares or that units, yes or no? So I've just taken the example of listed equity shares. Here it can be units also, yes or no? If these assets are acquired, these assets are transferring right now. But when did you acquire? Did you acquire prior to 1st February 2018 and now you are transferring? Or it is possible that you had acquired on or after 1st February 18 and now you are transferring. For example, you acquired these shares in 22-23. When did you acquire these shares? Meaning you have acquired on or after 1st February 2018. But if it is also possible that you would have acquired those shares in 2016-17. In the year 2016-17, meaning prior to 1st February 2018 you had acquired. Now see, if you had acquired these shares, listed equity shares on or after 1st February 2018, then your cost of acquisition will not be as per 55 to AC. 55 to AC will not be applicable. Here, your actual cost only will be treated as cost of acquisition. But if you had acquired them prior to 1st February 2018, then your cost of acquisition will either be your actual cost of those shares, or B, we are going to give you a option to take fair market value as on 31st January 2018. So you can take this actual cost also as cost of acquisition and the fair market value as on 31st January 2018. We are giving you the option to take this fair market value as the cost. So you can take the fair market value also as your cost of acquisition. But for that, the shares must be acquired prior to 1st February 18. Then here the cost, this cost is determined as per 55 to AC, which says that the assessee should be given the option to take the fair market value as on 31st January 2018 as cost of acquisition. But remember, this fair market value cannot be more than the selling price. Cannot be more than the selling price. So what are you supposed to do? Fair market value or selling price, whichever is lower, that lower amount will come. That lower amount or actual cost, whichever is higher, that you can take as your cost of acquisition. Now first I have just written all these things, don't worry. With a simple example I am going to explain everything. But first of all, follow whatever I am speaking right now. Okay, now tell me, let's make one example. Okay, in this example, Mr. Raman acquired listed equity shares of X Limited on 19th of January 2023. 19th January 2023 on a recognized stock exchange at rupees 380 per share. Brokerage at the rate of 1% and STT at the rate of 0.01% was paid on purchase. Okay, no? 0.02% was paid on purchase. These shares were sold by Raman on 1/2/2026 for rupees 470 per share on recognized stock exchange. Recognized stock exchange, I write NSE. NSE, National Stock Exchange, which is NSE only, right or no? If BSE also, then it is a recognized stock exchange. Okay, no? So he has purchased the shares on National Stock Exchange and he is selling those shares on that same exchange for rupees 470. Now he is paying brokerage at the rate of 1% and STT at the rate of 0.05%, 0.02%, example, 0.02%. Compute what? Capital gains for Raman. Very simple. This is the most simplest question which can be asked. Now here, tell me, what is the capital? No, sorry, what is the name of the associate? Raman, no? Okay, so we'll take Raman. Raman is an individual. Dash ROR. PAN is dash. Previous year 25-26. Assessment year 26-27. And computation of capital gains. Now to calculate the capital gains for Raman, first I have to see what is the capital asset. Tell me. What type of capital asset it is? Listed equity shares. So listed equity shares which were acquired on NSE and which is transferred on NSE. Yes or no? And at the time of acquisition as well as on transfer, at both the time STT must be paid. STT is paid? Yes. Okay. Now tell me, these listed equity shares are acquired on what date? Who was that? You? Huh? Why you are using your phone? Huh? I told you to keep the phone inside, no? Why are you using your phone? Why are you using your phone? Huh? So you are here to make the calls and receive the calls. Then why? Submit our phone here. Come on. Submit. Date of acquisition is? Tell me. What is the date of acquisition? 19 January 2023. And when it was transferred? 1st of February 2026. 1st of February 2026. Now can you see the shares are listed? For listed shares, This is your period of holding. Date of purchase to date of sale. Can I say this period of holding is more than 12 months? Therefore, the shares are long-term capital asset. Yes or no? And now you are going to calculate LTCG, and now this LTCG will be calculated under section 112A. Understood? Tell me yes or no. No. Now this LTCG will be calculated under section 112A. Okay. So how will you calculate? First we'll take full value of consideration, which is nothing but, so tell me how much selling price per share? 470, no? 470 into how many shares? The shares are not given. I'll write down acquired listed equity shares, and I'll write the number 1000 listed equity shares. Okay, no? 1000 listed equity shares. So selling price will be 1000 shares into 470. Tell me. 4,70,000 will be the full value of consideration. Less what? Transfer expense. So in transfer expense, at the time of transfer, you are paying brokerage also and you are paying STT also. Will you take the reduction for STT? Ignored. And for that you are going to write down a note. But the deduction for STT is not available at the time of calculating capital gains. Hence, STT paid at the time of transfer as well as at the time of acquisition have been ignored. That note, simple note you are supposed to write. Okay, no? So now tell me, what is the brokerage? 1% of 4,70,000. That will be, reduce that. 465. This is your net consideration. Now from this, you are going to reduce. Now tell me, if you calculate your capital gain under section 112A, you are supposed to take cost of acquisition. You are supposed to take, will you apply 55 to AC? If you will apply 55 to AC, then the cost will be this much. Yes or no? Actual cost or fair market value as on 31st January 2018, whichever is higher. But your fair market value cannot be more than selling price. Yes or no? Can you apply this? You can apply this only if the shares are acquired prior to 1st February 2018. Now in your question, check the date. When these shares were acquired? On or after 1st February 2018, their 55 to AC is not applicable. You are supposed to take the actual cost only as cost of acquisition. Understood? So what cost of acquisition you are going to take here? Cost of acquisition under section 55 to AC, the answer is no. This will be nothing but your actual cost. And what is your actual cost, sir? 1000 shares you acquired for, this is 100 into 470, no, you have done, how many? You have done 1000, no? I have by mistakenly written 100. 1000 shares into 470. That is giving you 4,70,000 only, no? Okay. Now 1000 shares, at what cost you had acquired? 380. So here it will be 380. So it will be 3,80,000. Simply 3,80,000 you are supposed to reduce. 85,000. Can I say this is your long-term capital gain under section 112A? Is this more than 1,25,000 or within 1,25,000? On this, how much tax you are going to pay? Nil. No tax, because the amount is less than 1,25,000. Understood? Now in that same question which is given above, okay, no, same question, we'll keep the question same and we'll change the information a little bit. If in that same question, if the shares, listed equity shares were purchased on 19th of November 2017, 17. 19th November 2017. Meaning prior to 1st February 2018. And the fair market value is also given in the question. Okay, no? So now let's say, assumption, in the above question, what would have been your answer if the shares were acquired on 19th of November 2017 and fair market value of such shares as on 31st January 2018 was 410 per share. Okay, no? So what would be your answer? Simple. Are the shares acquired prior to 1st February 2018? So now your cost will be determined like this. So you are going to take actual cost, that is 380. What is the fair market value? 410, which cannot be more than the selling price, which was 400. So 410 or 470, whichever is lower. So you can take 410, 410 or 380, whichever is higher. 410 can be taken as your cost of acquisition. Understood? So let's now go ahead and do the solution. What are we going to do? Computation. Now the same thing we are going to write down. Okay, no? Raman, this, that, everything. Same thing we are going to write. But what will change? Tell me. You tell me what will change. Date of acquisition will change, no? Date of acquisition will now be 19th of November. So instead of 19th of January 23, it will be 19th of November 2017. So from here till here, the period of holding is still more than 12 months. Therefore, the asset is long-term capital asset. And now in this case also, the long-term capital gain under section 112A has to be calculated. Okay. Now can I say this will remain same? This everything will remain same. Okay, no? Now only the cost will change. Only the cost of acquisition will change. Now the cost of acquisition will be as per. Now here you are going to apply 55 subsection 2 clause AC. Why? Because the shares are acquired prior to 1st February 2018. Okay, now? So here you are going to take A, actual cost. Tell me, what was the actual cost? 380, no? Wrong. Because at the time of purchase, you paid brokerage also. So brokerage will also be added to the cost. So 380 plus 1%, 38. 38 only, no? 3.8. It will be 383.8 into 1000. So 1000 shares into 380 plus 1% brokerage will give you how much? 3,83,800. Actual cost you can take, or you can take fair market value also. FMV on which date? 31st January 2018. This will be always given in the question. Okay. So what is the fair market value? Tell me. 410 we had assumed. Okay. Now whenever you are taking this 410, no need to separately add brokerage, etc. Brokerage you are going to add in actual cost only. Okay, no? So here 1000 into 410 will be 4,10,000. But remember, your fair market value cannot be more than your selling price. And selling price is 1000 into 470 is equal to 4,70,000. Yes or no? So this or this, whichever is lower. Lower is what? So 4,10,000 is lower amount, or 3,83,800, whichever is higher. Whichever is, so higher is how much? 4,10,000 that you reduce, and you are now going to get your long-term gain. 55,300. This will now be your long-term capital gain under section 112A. Yes or no? Now this is the question. Now in this same question, can we twist the information a little bit? Little. Instead of date of transfer, date of acquisition we will keep the same. But instead of fair market value being 410, we'll change the fair market value. We'll take the fair market value 500 rupees per share. Okay. So, same thing, copy and paste. What am I going to write? In the above question, what would have been your answer if the shares were acquired on same date and the fair market value was 500 per share? 500 per share. Possible? How the solution will be there? Same. This will be same. This will be same. Everything will be same. Only the cost of acquisition calculation will change. Okay, no? So what are we going to do? I'm going to tell you the logic of this one. Don't worry. Just right now focus on the calculation. Focus on the calculation. Logic, everything I'll give you. Okay? Why we are doing this? What is the reason for doing this? Everything I'll tell you. Don't worry. So now in this question, okay. The name of the assessee is this. Listed equity share is there. Period of holding is this. Now we are going to calculate what? Long-term capital gain under section 112A. How to calculate this long-term capital gain? Same, sir, like this only. Like this only. Okay, no? So first we are going to take the selling price. How much was the selling price, sir? How much was the selling price? 470. Transfer expense, same. Okay. Now only the cost of acquisition will change. How will you do that? Simple. You are going to take actual cost. So A, what is the actual cost? Tell me. A, actual cost will be 1000 into 380 plus 1%. How much is that? 3,83,800. Or B, we are supposed to take the fair market value as on 31st January 2018. And that fair market value was how much? Now this time the fair market value is 500. So 1000 into 500 will be 5 lakhs. But remember, this fair market value cannot be more than selling price. So selling price was 1000 shares into 470, which is 4,70,000. Here, this or this, whichever is lower. So what is lower? 4,70,000 or 3,83,800, whichever is higher. So tell me whichever is higher. 4,70,000. Reduce that. 4 lakh. Positive, negative? Negative. How come negative? Because this is okay, no? Selling price is okay, transfer expense is okay, and now the cost we have determined, that cost is 4,70,000. Yes, perfect. Tell me. 4,070. This is negative. This is long-term capital loss. Okay. This is long-term capital loss. Okay. One more thing. Now let's say in that same example, okay. Now we'll take the cost. What was the cost? 380. What was the cost? 380. And we'll take the fair market. We'll change the fair market value also, and we'll change the selling price also. Two things we are changing. What? Fair market value as well as selling price. Both the things we are changing. Okay. So now tell me. In the above question, what would be your answer if the shares were acquired on this date and the fair market value was 360 rupees per share and selling price was 300 rupees per share. Okay. Shall we? Okay. So tell me, how to calculate? Same thing. Listed equity shares. Now the period of holding will be same. Should I start directly from here? Okay. No need to do this calculation again, no? Because everything is same. But still, let me do it. Copy paste is only to be done, no? So, listed equity shares. When did you buy? Same date. When did you sell? Same date. Asset is a long-term asset. Long-term gain needs to be calculated. Now tell me what information is changed. Full value of consideration, which is selling price. Now how much is that? 300 rupees per share. So 1000 shares you are selling for how much? Now 1000 shares you are selling for 300 rupees per share. So this will be 3 lakhs minus transfer expenses is what? Brokerage. 1% brokerage. 1% was there, no? Brokerage was 1%? Tell me how much? 3000. Reduce that 3000. 2,97,000. This is your net consideration. Now, less cost of acquisition. Now, this cost of acquisition will be under section 55 to AC, since the shares were acquired prior to 1st February 2018. What is that cost? A. Actual cost, which was 1000 into 380 plus 1% will be same, 3,83,800. But this cannot be more than B. Fair market value as on 31st January 2018. How much was the fair market value? 1000 into 360. Now we have changed, no? 360 will be. But remember, this fair market value cannot be more than selling price. And how much was the selling price? 1000 into 300. Yes or no? So this is 3 lakhs. So 360 or 3 lakhs, whichever is lower. So 3 lakh is lower, 3 lakh or 3,83,800. Whichever is. So tell me higher amount. 3,83,800 will be my cost of acquisition, which I will reduce out of 2,97,000. So how much will be there? 86,800. This is negative. This is your long-term capital loss. Will you be able to do these kind of calculations? Now the logic behind this calculation I am telling you, okay? Logic. Why this type of cost they are telling you? See, you are an assessee, okay, no? In the year 2016-17, in which year? 16-17. Let us take our example only, no, that question only. So, when did you acquire these shares? For example, 19th November 2017. So, on 19th November 2017, You acquired the shares. So your cost of acquisition of these shares was how much? 380. 380. Okay. Now, see, when you acquired, no, at that time, this long-term capital gain under section 112A was not in existence. At that time, 1038 was in existence. I told you earlier only. Yes or no? See, this time. I told you here only. Prior to 1st April 2018, if you calculate long-term gain, it will be exempt under section 1038. So at the time when you bought, the shares on 19th of November 2017, meaning prior to 1st April 2018 you have bought, at that time you are under an impression that I will hold these shares for more than 12 months. The capital gain will arise, will be my long-term gain, and it will be exempt under section 1038. Because at the time when you bought the shares, hello, you were not knowing that in future the government is going to charge the same gains under the Income Tax Act. At the time of buying, you were under an impression that if I hold these shares for more than 12 months, the shares will become my long-term asset, and when I transfer the shares as long-term asset, long-term gain will arise. That will be exempt under section 1038. At the time of buying, you were under this impression, no? Now, you know, government brought this amendment in which year? 2018. So with effect from 1st April 2018, the amendment is applicable, but that amendment was announced in budget. And by the way, budget is announced on 1st of February 2018. Hence that date is important. Now tell me, on the night of 31st January 2018, when you slept, okay, no? When you slept, okay? Let's say that instead of November to November 18. Okay. Let's take this 2016 only. Okay, no? 16. So when you bought in the year 2016, at that time, you thought that I'll be holding it for more than 1 year. So now see, on the 31st January 2018 night, when the fair market value of these shares, in my first example, how much fair market value did I take? How much fair market value did I take? In this example, 410. Yes or no? So let's say 410. Okay. So fair market value was how much? 410. Now tell me, your shares which you bought for 380 are worth how much? Is there an appreciation in the value of shares? Appreciation of how much? Appreciation of rupees 30 multiplied by 1000 rupees. Multiplied by, 1000 shares. 30,000 gain is there as of now. Night when you went to sleep, no, that time you were very happy. That see, I have already held the shares for more than 12 months. Holding period is more than 12 months, yes or no? And now, 30 rupees gain is, as of today, I'm in 30 rupees gain. Although that gain is not realized because I have not sold the shares, but as per the value, if you see, the gain is 30 rupees right now. Whenever I will get this gain of rupees 30,000, at that time it will be exempt. You are so happy when you slept. Next day morning, next day is 1st of February 2018, budget day. The budget for 18-19 will come. Morning time, our finance minister, who? No, that time finance minister was Mr. Arun Jaitley. That time, Mr. Arun Jaitley was the finance minister. He came into parliament, immediately announced that with effect from 1st April 2018, the long-term gain which was exempt under section 1038 will no more be exempt because we are scrapping section 1038. We are omitting section 1038. And now the same long-term gain will be taxable under a new section 112A. But since this gain was earlier what? Exempt, and we are taxing it, no? So we are not going to tax it fully. On the first 1 lakh we are not going to charge tax, and on the excess amount we are going to charge only 10% concessional rate. Long-term gain which was first fully exempt will now be covered under 112A. Will now be covered under 112A. And now this type of long-term gain, which was earlier exempt, will not charge fully. No. On first 1 lakh we are not going to charge any tax. So people, you're not supposed to worry if your gain is up to 1 lakh, that is still exempt because we are not going to charge any tax. But anything over and above 1 lakh, that means you are not a small assessee, you should pay a little tax on that. And that tax also we are not charging too much. They are charging only 10% concessional rate. That way the amendment came. And now that same 1 lakh is changed to 1,25,000 as of now. And that same tax rate which was 10% at that time is now how much? 12.5%. Getting my point? So tell me, this announcement came on which date? Prior to that you were not aware only, no? Okay. Now see, still you have some time to sell the asset. You have February month time and a March month time. Till March if you will sell, whatever gain will happen, long-term gain will be exempt because 1038 is applicable till 31st March 2018. But if you don't sell till 31st March 18 also, then from 1st April onwards, now the gain will be taxable. Now the gain will be taxable, but we are not going to charge tax on that gain which accrued up to 31st January 2018. Because till that time you were not aware only that this type of gain will be chargeable to tax. So till the time 31st January 18, whatever gain was accrued, that gain we are not going to charge later on when you are selling these shares. So for example, if you are selling these shares in previous year 25-26 and you are selling them for how much? Your selling price here was 470. So selling the shares for 470 and cost is taken as what? 380. 470 minus 380 will give you a total profit of 90. If we charge the entire 90, what will happen? We'll charge this 30 also, and which is wrong. Because this 30 is for that period for which you are not aware that this gain is ever going to be taxed later on. Yes or no? So we should not be charging the tax on this gain up to 31st January. So we are giving you an option. We are giving you an under section 55(2) AC. That if you had acquired these shares prior to the announcement made in the budget, prior to the 1st February 2018, any time prior to that date if you have purchased. So we are going to give you the option to take what? Option to take the actual cost also as cost and fair market value as a cost. Fair market value as on 31st January 2018. Now whenever you will calculate the capital gain, your selling price 470 will be full value of consideration minus transfer expense. Let us say there was no transfer expense, so net consideration will be 470 minus cost. What you are going to take? If you would have taken 380 cost, how much cost? So capital gain would have been 90. Meaning that the gain for this period was how much? Gain for this period was 60. The entire 90 rupees gain would have been charged. Yes or no? So by doing that, we would have charged the tax for this period also, which is wrong if we do. So we are not willing to do anything wrong with you. The gain up to this period we will not charge later on also. But to do that, we should give you an option. Option to take the fair market value as on this date as your cost. So if you want, you can take the actual cost also, or you can take fair market value, whichever is more beneficial. So what is more beneficial? 380 or 410? 410, 380 or 410, whichever is higher, whichever is. So what cost you are going to reduce? Out of 470, instead of reducing 380, now you reduce what? How much will be your gain? So the gain only for this period will be charged to tax. Gain only after 31st January 18 will be charged to tax. Any gain prior to 1st February 2018, prior to the announcement, when you were not aware about the taxability of this gain later on, till that date, whatever gain is there, that will be out of the income tax. This is known as grandfathering. This is known as grandfathering. Grandfathering the gain. Retiring the gain. Grandfathering means retiring the gain out of the calculation. That we don't want to charge the gain up to this period as your capital gain. So we are grandfathering this gain. So in the technical terms, this is also a concept of grandfathering. If someone asks you what is grandfathering, this is grandfathering. Okay. So gain up to 31st January. Now see, this option we are giving to take the fair market value as on 31st January as your cost. We are giving this option only for those shares which you have acquired prior to 1st February 2018. So when did you acquire? Prior to 1st February 2018. So you can take what? You can take actual cost also, or you can take fair market value, whichever is. But your fair market value should not be more than selling price. So here in the first case, what cost we took? Tell me. A, actual cost, which was how much? 380. Or B, fair market value on 31st January 2018, which was 410, which cannot be more than selling price, which is 470. So this or this, whichever is lower will be 410, 410 or 380, whichever is higher. So 410 will take the cost. So out of 470, if we reduce 410, what will be your gain? 60. The gain only for the period after 31st January will be charged to tax. And we did the same thing in our first solution. But our answer was a little bit different because we reduced the brokerage, etc. also. No? Yes or no? Sure? Second example. Should I change this example? Okay. Now see, the same thing. When did you acquire? 19th January. Okay, no? 19th January. The cost was 380. Now I changed the fair market value to 500. Did I change to that 500? Tell me yes or no. Now, from here to here, what was the gain? The gain was 120. This gain should not be charged to tax. This gain should not be charged. But after that, there is no increment in the value. There is a decrease in the value by 30. So net amount is how much? Net amount is 90. And that 90 is the gain for that period only. That period gain should not be taxed. So finally your gain should be, taxable gain should be nil. And that is possible only if you take cost as per 55 to AC. So here what cost you are going to take? Same to same. Same to same. Now pay attention here. What will happen now? Instead of fair market value of 410, now you are going to take the fair market value of 500. Yes or no? 500 or 470, whichever is lower. 470 or 380, whichever is higher. 470. So how much is your selling price? 470. How much cost is allowed? 470. 470 minus 470 will be nil. Why nil? Because entire gain relates to which period? Prior to 1st April 2000 1st February 2018. If you see, for this period 120 gain was there and this period 30 was a loss. So net gain of 90, and then 90 is out of this 120 only, no? So even that 90 should not be charged. Understanding? So gain after 1st February will be taxed. But any gain prior to 1st February will not be taxed. If you take the cost like this. Understanding? Now tell me, third case also I told you. In the third case, I changed my fair market value as well as selling price. Fair market value as well as, what did I do? I took the same thing and fair market value instead of 500, I took the fair market value at what? Check. I took the fair market value as 360 and selling price I took 300. Yes or no? So let's take that only, same to same. So if my cost of acquisition was 380, the fair market value was how much? 360, and I sold it for 300. Meaning that I'm already in a loss of 20 and my loss further increased by 60. So my total loss is how much? 80. And that is my actual loss. Don't worry, that actual loss will be calculated if you take your cost like this. Take your cost like this. What are you going to do? Come on, tell me. Actual cost or fair market value? Yes or no? Take this. Tell me. Here it will be. Actual cost is 380 only. What was the fair market value? 360. What is the selling price? So your fair market value should not be more than selling price. So this will be 300 or 380? 380. So out of the selling price of 300, reduce 380. 80 will be your loss. And that loss is very well calculated. See, this entire loss is calculated, which is your actual loss. 380 rupees item you are selling for 380 rupees of real loss is there, no? So real loss will also be calculated if you will take the cost like this. So if you will take the cost under section 55 2AC like this, what will happen? The gain up to 31st January 18, if any, will not be charged to tax. The gain after this period only will be charged to tax. Understanding? And if there is a real loss happening, that loss will also be calculated and will be allowed as a set-off. If you take your cost like this. Understanding? Sure. And why our losses were a little different? In the first case, see, in this case, why my loss was, why there is negative, this is 55,300 positive? Because of this 4,700. If this brokerage was not there, how much would have been the gain here? 60,000. How much would have been the gain here? 60,000. If that brokerage would not have been there, 60,000 means 60. I've already done that calculation. Yes or no? If this brokerage would not have been there, 4,700, here there would have been nil. Why nil? Entire cost would have been, entire selling price would have been allowed as a cost. 380 or 500 or 470. 500 or 470, whichever is lower. 470. Hello? 470 or 380, whichever is higher, 470. So out of 470, 470 is reduced. How much is the gain? How much is the loss? Nil. It would have been nil. Why it is negative 4,700? Because of that brokerage. If the brokerage would not have been there, there would have been a loss, which I have already calculated. So in all my examples which I have taken, these are the same examples, the question which I have taken. Yes or no? But brokerage is not included to make the calculation simpler so that you understand the amounts. Understood, sir? Sure. Now, what I'll do in these questions now which I have given, first question is this, no? First question is this. Here, did I apply 55 to AC? Why? If you acquire the shares on or after 1st February 2018, the option of 55 to AC is not available. That option is available only if the shares are purchased prior to 1st February 18. That's it. Grandfathering is available for that gain only. Yes or no? Understood, no? In the second case, I took what? See, date of transfer I will do, date of acquisition I will write down 2016. Okay, no? Here also I will do 2016. And here also I will do 2016. All these three examples I have discussed here. So this was my first example. Second example. This was my third example. And this was my fourth example. Total 4 examples I have taken. In these 4 examples, out of 4, first example 55 2AC is not applicable. Second example 55 2AC applicable, not applicable. Applicable. Why? Because the acquisition was prior to 1st February 2018. Yes or no? Third example also it is applicable. And in the third example, only the fair market value has been changed. Everything remains same. In the fourth example, same thing, 55 2AC applicable, but I have changed fair market value as well as selling price in order to calculate the real loss. So in the first example, gain prior to 31st Jan ignored, gain on or after 31st Jan is considered. That calculation we have done. In the second example, no gain, no loss will be charged because whatever gain is there, if any, is prior to 1st February 2018. So that gain is not taxed and afterwards there is no gain only. Yes or no? So nothing will be charged. In the second example. Third example, there is a real loss which you have already calculated. How much was the loss? The loss prior to this date was 20. Loss after this date is 60. 60 plus 20. Total loss of 80. That loss should be calculated. Understood? So, these are the questions which you should practice. Guys, these are the questions which you should practice. In the examination, if these type of questions are coming, 100% I am telling you, will be for minimum 4 marks. Minimum 4 to 6 marks. One small question like this. Or a case study they will prepare for MCQ, and out of this case study, they will ask you 2 or 3 MCQs. Understanding? Okay. Now, with this, the first part of the chapter is over. What is the first part? Basics. Basics over. Now, let's try to see if any questions from the ICA study mat we can solve. Okay, no? Illustration number 1. Okay. What is this illustration? How will you calculate the period of holding in case of the following assets? Okay. See, for this point number 1, no? Point number 1, there is one section 46, which I am going to do with the second part of the chapter. Okay, no? In section 46, you will come to know about this. But as of now, tell me, bonus shares, how will you calculate the period of holding of bonus share? How will you calculate? How much you are supposed to take? No. Am I asking 12 months, 24 months? No. They're telling you how will you calculate the period of holding of bonus shares. You know that from the date of allotment till the date immediately preceding to date of transfer. If the bonus shares are unlisted. And if they are listed, then from the date on which they are credited to your demat, from that date till the date of sale. Understood? How will you calculate the period of holding a flat in a cooperative society? There is a flat in a cooperative society. So will you buy that flat? Will you buy that flat? Yes. But you will not become the legal owner. But still that flat will be registered on your name as on the date of registration. As on the date of registration, you get that right of ownership. From that date, you become the owner of that flat till the date of transfer. Understanding or not? So you read this question once at home. Okay, no? Only reading is required. And this first part you will come to know after we discuss section number 46. Okay. Come to illustration number 2. A is the owner of a on 1st of April 2025 he starts a business of wait. There is one section 45.2. Okay, this is on 45.2. No, right now no need to do that question. Okay, no, illustration 2 leave right now. Move on to the next illustration. No, this is on section number 47 that we are going to do later on. This is also 47. Senior citizen mortgage. This is also section 47. Leave all the illustrations first. In earlier illustrations you are supposed to leave. Okay, no? This section 49 also you are supposed to leave this right now. So there are many things which I have to first do. Only then I'll be able to pick up any illustration out of this. Converts capital asset into stock in trade. Okay, no. Capital asset into stock in trade 50/58. Okay. Wait. Give me 2 minutes, huh? Give me 2 minutes. I'll find out 1 or 2 questions for you. We'll first solve those questions and then I'll do that discussion with you. Okay, residential house. This section 54 and all. 54 EC. Guys, this one also not a single question from ICA study mat you can solve right now. Okay, no problem. So we'll start with the second part of the chapter. Okay, no? No. Question number 1. Test your knowledge. Yes. This is a good question. Okay. Start question number 1. Come on. Test your knowledge. Question number 1. Start. What is the name of the assessee? Mithun. Mr. Mithun, no? Individual ROR. PAN dash. Previous year 25, 26. Assessment year 26, 27. What are you computing? Capital gain, no? Computation of total income. Now to compute that total income, you need income of 5 heads. Unit salary not given in the question. House property not given in the question. PGBP not given in the question. But other incomes are given, no? Other incomes you take later on, but first you will calculate capital gains. In the capital gains, you will add other incomes. You will get GDI. From that, you will take Chapter 6 deduction. You will get total income. Yes or no? So first we are going to calculate what? Capital gains. Capital gains. Capital gains on transfer of what? Listed equity. Wait. Only capital gain I will write. Capital gains. And here I will write what is the capital asset. Capital asset is listed equity shares. Now these listed equity shares acquired on stock exchange, no? Acquired on NSE, given in the question. So, Good Money Company Limited, public issue, paying STT. Okay. So, in a public issue, meaning STT is paid. So, at the time of acquisition, STT is paid and they are transferred also. At the time of transfer also, STT is paid. Acquisition date. Tell me the acquisition date. 1st April 2007. 1st April 2007. When these shares are sold by him? 1st October 2025. 1st October 2025. Okay. Now, date of acquisition, date of transfer. Can I say this is period of holding, which is more than 12 months. Therefore, long-term capital asset. And for this long-term capital asset, you are going to compute long-term capital gain. Under which section? 112A. Yes or no? Now this long-term capital gain, to calculate this, first what do you want? Full value of consideration, which is nothing but selling price, which is equal to how much? 4,000 rupees per share into 100. So 4,000 per share into 100 shares. So how much? How much? 4 lakh you will write in inner column. 4 lakh you will write in inner column. Less what? Transfer expense. In transfer expense, brokerage is there. How much brokerage? 1%. So brokerage at the rate of 1%. 1% of 4 lakh will be 4,000. Can you reduce 4,000? How much is the net consideration? 3,96,000. Everyone got 3,96,000 or not? This is net consideration. Out of this, will I reduce cost of acquisition? My cost of acquisition of these shares will be as per 55(2) AC. Why? Because these shares were purchased prior to 1st February 2018. So cost of acquisition will be under section 55 subsection 2 clause AC. How much cost? A, which is actual cost. Tell me how much is the actual cost? 1000 rupees per share now into 100 shares. And at that time of purchase, did you pay any brokerage? No brokerage. So what was the actual cost, sir? 1 lakh. This actual cost can be taken as cost of acquisition, or you can take B, fair market value as on 31st January 2018. Fair market value given in the question. How much? 2000. In the last line you can see 2000 into 100 will be 2 lakhs. And 2 lakhs cannot be more than selling price. How much is the selling price? 4000 into 100 will be 4 lakh. So 2 lakh or 4 lakh, whichever is lower. Whichever is lower. So lower will be 2 lakhs. Yes or no? Either this 2 lakhs or 1 lakh. Whichever is higher. So higher will be 2 lakhs. So therefore the cost will be 2 lakhs. So reduce 2 lakhs. 1 lakh. Outer column you are going to write down 1,96,000, and in front of this you are going to write, this is your taxable LTCD under which section? 112A. Yes or no? Now other incomes are given in the question. Yes or no? Other incomes of 8 lakhs. Sorry? Bonus shares. Oh, bonus shares also given. No. So bonus shares are given on what date? 1st December 2024. Yes. So now I'll calculate the capital gain. So capital gains, this is my first capital gain. Okay, no? Capital gain on listed equity shares which are acquired. Okay, which are acquired. Now second capital gain also I'll calculate. Second capital gain, capital asset is what? Listed bonus shares. How much? How many bonus shares? Bonus shares are issued in the ratio of 1:1. So guys, bonus shares are acquired on what date? Acquired on 1st December 2024. And these bonus shares are sold on what date? Same date, no? So the date of transfer is 1st October 2025. So transferred means sold on 1st of October 2025. Tell me the period of holding. Less than or more than? So this was greater than 12 months. This is less than 12 months. Guys, see, these listed bonus shares now, at the time of acquisition, usually on bonus shares, STT is not charged. So that is an exception. That is okay. So even if at the time of STT, at the time of acquisition, the STT is not charged, but since bonus shares are there, how the STT will be charged? So it is an exception. If it was more than 12 months, then also the long-term gain would have been gone in 112A. Yes or no? So for 112A, what is the requirement? That STT must be charged at the time of acquisition also, as well as at the time of transfer also. But in some cases, it is practically impossible to charge STT. So those are the genuine cases. Out of those cases, bonus shares is also one of the cases. Yes or no? Where STT is not charged. So in the case of bonus shares, even if the STT is not charged at the time of acquisition, still the long-term gain will be covered by 112A. Yes or no? But here the long-term gain is not coming. Here short-term gain is coming. Now tell me, will you transfer these bonus shares also or stock exchange? Because if you are having listed shares and on the basis of listed shares you are getting the bonus shares, so the bonus shares are also listed only, no? So if you will transfer them, you are going to transfer them on stock exchange. At that time you will pay STT. So now the period of holding is less than 12 months. So therefore it will be short-term capital asset, but now your short-term capital gain will be 111A. Which one? This is STT paid short-term gain. This is STT paid short-term gain. It will go to 111A. Yes or no? But if it was long-term gain then it was STT paid long-term gain. It will go to 112A. Understood? So now tell me, will you calculate the short-term capital gain? So short-term capital gain you are going to calculate. Okay. Now to calculate this short-term gain, what are you going to do? First you are going to take full value of consideration, which is nothing but selling price. Tell me how much selling price? 4,000. On how many shares? 100 shares. So it will be 4 lakhs. Done, sir. Now minus what? Any transfer expense will be there? Yes. On the bonus shares also you are going to pay what? Brokerage. So 1% brokerage. 1% brokerage will be 4,000. So your net consideration will be 3,96,000. It will be net consideration minus cost of acquisition 55 to AC, no? 55 to AC. Then for bonus shares, how will you apply 55 to AC? Can you apply 55 to AC? Yes. If these bonus shares were acquired prior to 1st February 2018 and you would have been calculating the long-term gain. I'll tell you about that also. Yes or no? So first of all tell me, are these bonus shares short-term or long-term? Are you calculating long-term gain or short-term gain? So whenever you calculate short-term gain, 55 to AC is not applicable also. 55 to AC is applicable only if you calculate long-term gain under section 112A. Are you calculating long-term gain under section 112A? 55 to AC is not applicable. And what is the cost of bonus shares? Nil. Actual cost. Yes or no? So you are going to take actual cost only as what? Cost of acquisition, which is nil. So tell me how much? 3,96,000. This will be your taxable gain. 1,96,000 I'll write here and 3,96,000 I'll write here. Okay. So now tell me, this 1,96,000 is your long-term gain and this 3,96,000 is your short-term gain. Okay, no? So A plus B total 5 lakh. So income under the head capital gain is 5,92,000. But out of that 5,92,000, some gain is long term and some gain is short term. While calculating the tax liability, you are supposed to be careful about that. Okay, no? Now should I write other incomes? Other incomes. Other incomes given in the question only. And other incomes are normal incomes. Taxable at what rate? Normal rates are 115, BSE rates. Depends on the type of regime followed. What the question is saying, that the assessee is shifting out. Assessee Mithun opts out of default tax regime. Meaning for him, normal tax rates are applicable. Yes or no? So now can you calculate the GTI? 13,92,000. This is your gross total income. Out of that, less deductions under chapter 6A. There is no chapter 6A deduction given in the question. So, what? Shit. My mistake, my mistake. Company, he also received, no? He also received dividend 10 per share on 1st May 2025. So, with other incomes, I will have to include one more income. My mistake, guys. Sorry. I could not read the question properly. In a hurry. Why are you in a hurry, sir? So, here, can I write income from other sources? So, under the head, other sources, will you have dividend income? So, dividend income will be on how many shares? Dividend income will be on how many shares? On 1st May 2025, you are getting dividend. So as on 1st May 2025, you are having 100 shares, original shares also, and 100 bonus shares also. 200 shares you are having. So on those 200 shares, you are going to get what? Dividend. So 200 shares dividend. Per share dividend is how much? 10 rupees given, no? So 200 shares per share, 10 rupees dividend. So 2000. So that 2000 will be your income from other sources. And other incomes are also given. Yes or no? Now there is no income remaining, no? Sure? Okay. Now we'll do the total. Now it will be my gross total income. How much is that now? 13,94,000 minus deductions under chapter 6A. How much, sir? Nil. So how much will be your total income, guys? 13,94,000. They have told me to calculate what? Total income. So if the question is having 8 marks, 5 marks for this, 3 marks for tax calculation also. Because tax liability is also to be calculated. Will we be able to calculate the tax? Simple. On this total income, I have to apply the tax rates. But on the entire total income, I cannot apply normal tax rate, because out of this income, some income is LTCG, some income is STCG, balance income is normal income. Yes or no? So now please pay attention. Computation of what? Tax on total income. Yes or no? So now to calculate this tax, what I'll do? I'll break up my total income. So tax on how much? 1 lakh 90, tax on LTCG 112A, LTCG under section 112A. How much? 1,96,000. On first 1,25,000. On 1,25,000, how much tax? Tell me. Is equal to nil. And 1,96,000 minus 1,25,000 on this excess. How much? 12.5%. 8,8875. Everyone getting this? So this is the total tax on my 1,96,000. So out of 13,94,000, see, out of 13,94,000, I have calculated tax on this amount. Now I will calculate tax on STCG under section 111A. And what was the STCG? 3,96,000 at what rate? 20%. So what is the 20%? How much? 79,200. Okay, no? And now tax on balanced total income. What is the balanced total income? Tell me. 8 lakh 2,000. Yes or no? At what rate? Normal rates. So at normal rates up to 2,50,000. How much tax? How much tax? Nil. Wait, it will be nil. 2,50,000 to 5 lakhs. On this, at the rate of 5%. So on 2,50,000, 5% will be 12,500. On 5 lakh to 8 lakh 2,000, it will be 20%. How much? 60,000. Add both of them. 72,900. And this directly I will write in outer column. 79,200 directly in outer column. And what is the total here? 8875. This also outer column. Yes or no? 8,875. Now calculate the total tax. 1,60,975. Can I say this is the tax on your total income? Tax on total income. This is the basic tax. Will you add surcharge on this? Why? Because your total income is 13,94,000, which is less than 50 lakhs. No surcharge. Will you add rebate? Why? Because your total income is more than 5 lakhs. Hence no rebate is also there. You will add health and education cess. Health and education cess will be at the rate of 4%. Calculate 4% of this. 6,439. Do the total. 67. The final tax liability is this much only. This is your gross tax liability. Out of this, any TDS, TCS, advance tax, etc. not there. Okay, no? So your net tax liability is same. How much? 1,67,414. But if you will write it like this, no, your answer will be wrong. You will have to round off. 1 mark will be gone if you forget to round it off. Okay, no? So this is rounded off under section 288B to the nearest multiple of rupees 10. 167,410. Go and check the final answer. My answer is correct? Or both the answers are correct? My answer is also correct, their answer is also correct. But the way of presentation will be a little different there, and my way of presentation is a little different. Okay, no? If you will present your answer like this, you will get full marks. And wait, there is one more way in which you can present it. Column wise. First column for 100 shares. Second column for 100 bonus shares. Yes or no? And only one table will be made for what? Capital gain calculation. From that you will get 2 capital gains. That you write. Then you write what? Other incomes. Then you write IFS income. Then you calculate the total income. So in the column also you can do a calculation. Understood or not? Okay. Now see, this type of question will come in the exam for how much marks? Minimum 8 marks. And mark this question important. Good question. Okay. Now, I want to put you in some trouble. Should I? Ready? You remember no 55 to AC? You remember? Pakka? Now see. What I am writing here, please pay attention. 3 assets listed: equity shares or units. Units of equity oriented mutual fund or units of business trust What is business trust? What is their units? All those things you are going to learn in finals. Yeah. Right now, just remember these names. That's it. But the main calculation at your level, CA intermediate level, will be on listed equity shares. Now see, if their period of holding is more than 12 months and their period of holding is less than 12 months, less than or equal to, less than or equal to 12 months, they will be long-term capital asset, yes or no? And they will be short-term capital asset, right? No? Now see, here you are going to calculate long-term capital gain under section 112A. And here you are going to calculate short-term capital gain under section 111A. Now when you are going to calculate the long-term capital gain, tell me. Conditions. And when are you going to calculate the short-term capital gain? Conditions. Simple. Transfer is on or after. At the time of transfer on recognized stock exchange. First of all, transfer on recognized stock exchange. First condition. On or after? On or after 1st of April 2018, and at the time of transfer, STT should be paid. STT should be paid. Okay. And one more thing, on acquisition also, STT must be paid in the case of listed equity shares. Only the case of listed equity shares. But there are certain exceptions. Like bonus is there, okay? Or it might happen that earlier you bought the shares which were unlisted. So at the time when you bought, it was unlisted, and later on the company gets listed. So you got listed shares in return of unlisted. Now your shares automatically become listed shares. So definitely at the time of acquisition you would not have paid STT. So there are certain exceptions. In those exceptional situations, if STT is not paid at the time of acquisition, then also it is okay. The gain will be covered by 112A. Yes or no? Now see, whenever you calculate this long-term gain, exceptions like example bonus, okay, no? Now whenever you are going to calculate the capital gains over here, you always have to see that such listed equity shares, if the acquisition was what? Prior to 1st of February 2018, or acquisition can be on or after 1st February 2018. See, if the acquisition is on or after 1st February 2018, the cost of acquisition will be very simple. What? Actual cost only. Done, no? But what if it is prior to 1st February 2018? You have to take actual cost also. Hello? But here, no, I will put you in some trouble. What is the trouble, you know? The shares, listed equity shares, were purchased in 96-97. 96-97 means prior to 1st February 18, yes or no? But it is prior to 1st February 2001 also. Will you get that option? Option to take fair market value as on 1st April 2001. Yes. So your actual cost or fair market value, whichever is higher. Fair market value as on 1st April 2001, whichever is higher. And that will now be compared with the fair market value as on 31st January 2018, which cannot be more than selling price. Understanding? So here, prior to 1st February 2018 means what? Prior to 1st February 2018 means what? Two possibilities. Two possibilities. One, prior to 1st April 2001 also, and on or after 1st April 2001. Okay, no? Here what is to be done, you know. What is to be done? A, actual cost, or B what? Fair market value as on 31st January 2018, which cannot be more than selling price. Yes or no? So this or this, whichever is lower. This or this, whichever is lower. Lower will come, lower amount or actual cost, whichever is higher. Done, sir? This you already know. This will be copy paste. But in actual cost, you will get the option of taking the fair market value also. As on 1st April 2001, if the shares are purchased prior to 1st April 2001 also. Yes or no? So two fair market value you will take. You will take fair market value as on 1st April 2001 also. And you will take fair market value as on 31st January also. Where? In this case. So here, how the things will be written. Same thing you are supposed to write. What? Same thing. Copy, paste. Done, sir? But what are you going to do now? Shift this a little bit below. Delete. Shift this a little bit below. Now this will be actual cost or fair market value as on 1st April 2001. This or this, whichever is higher, whichever is understanding. So higher amount will be this amount, okay, this higher amount, and lower of these two, whichever is higher. Now this will become your cost of acquisition. Will you remember this? Sir, will you remember this? This is only if the assets are acquired prior to. Okay. Now this same thing you have to do for shares which are bonus shares also, shares which are right shares also. Not just the shares which you have purchased, but for the shares which are bonus shares, this entire thing will be applicable. This entire thing will be applicable in the case of bonus shares also, if the bonus shares are listed. And this entire thing will be done for right shares also, if the right shares are equity shares and they are listed. But this entire thing you are going to do only if you are going to calculate what? Long-term capital gain under section 112A. If the period of holding is more than 12 months, you are going to calculate long-term gain, only then you are going to do all these things. Understanding? So let's say you acquired 100 shares. Mithun, the question, last question which we solved. Yes or no? When did you acquire those shares? 1st April 2007. Yes or no? And what if bonus shares were issued? When the bonus shares are issued in that question? 112. So bonus shares are issued on 112. On 112, meaning on or after 1st February 2018. Yes or no? So what is the cost of that bonus shares? Actual cost. We took actual cost. Okay, no? And by the way, those bonus shares period of holding is also less than 12 months. So we are not going to calculate the long-term gain. What if that date was changed? For example, Mithun got 100 bonus shares on 1st of December 2016. He got bonus shares on 1st of December 2016. Forget it, 2015. 1st December 2015. Can I say 1st December 2015 is prior to 1st February 2018? Yes or no? And also, these bonus shares are also long term. So for these bonus shares, now the capital gain will be long term gain. Under section 112A, even if no STT was paid at the time of purchase, still the long term gain will be calculated under section 112A. Understanding? So tell me, period of holding, 1st December 2015 to date of transfer, 1st October 25. 1st December 2015 to 1st October 25. Period of holding is more than 12 months. Period of holding is more than. Asset is a long-term asset. Long-term gain will be calculated even if STT is not paid at the time of acquisition, because the shares are bonus shares. Yes or no? So now tell me, when the acquisition took place of this bonus shares? The example which I've changed, 1st of December 2015. 1st of December 2015. Meaning on or after 1st February 18 or prior to 1st February 2018. So what cost will be taken? Actual cost, which will be nil. Bonus shares, actual cost is nil. And what will be the fair market value? As on 31st January 2018, the amount is given 2,000 rupees. And the selling price is 4,000. 2,000 or 4,000, whichever is lower, 2,000. 2,000 or nil, whichever is higher, 2,000. So in that case, I would have taken the cost as 2,000 for those bonus shares. Understanding? If the bonus shares would have been long term in my question. Sure? What if those bonus shares were acquired prior to 1st April 2001 also? This thing, actual cost, nil. Fair market value as on 1st April 2001, whichever is higher. Always this fair market value will come as higher amount. And then fair market value as on 31st January 2018 or selling price, whichever is lower. This lower amount or this higher amount, whichever is higher, will become the cost of acquisition. Done, sir? Sure. So I am writing the above discussion is equally applicable for listed equity shares issued as what? Bonus shares or right shares also. So not just for acquired shares, but for bonus as well as right shares. Same discussion is applicable. Understood? Now whatever capital gain will be here, which will be under section 112A, what are you going to do? Up to 1.25 lakhs. How much tax? Nil. And excess amount. Excess amount at the rate of 12.5%. Done, sir? Done, sir? Now tell me, short-term gain. What if the asset is any of these three assets and period of holding is less than equal to 12 months? Possible? Listed equity shares are there. The period of holding is less than. So you will calculate which gain. But for this, what conditions must be satisfied? They must be transferred on recognized stock exchange. And at the time of transfer, at the time of STT must be paid. STT must be, and transfer is done on or after 1st of October 2004. Because section 111A was introduced from 2004 onwards. Understanding? So on or after 1st October 2004 means if I am transferring right now, I am transferring on or after 1st October 2004 only, no? So even if you don't remember these two dates, no, then also there is no problem. But since these dates are given, you should know the relevance of these dates. Prior to this date, the long-term gain used to be exempt. Hello? And prior to this date, the short-term gain used to be taxed at normal rates. So with effect from this date onwards, the short-term gain is taxable at concessional rates. Earlier it was 5% only. Then it was increased. After few years it was increased to 10%. Then after few years it was increased to 15%. And last year this tax rate has been increased to 20%. So when the first time this type of short-term gain started getting taxed under section 111A, it started getting taxed at a very concessional rate of 5%. Because government wanted everyone to do the buying and selling transaction on the stock exchange, so that the transactions gets recorded and nobody is able to evade taxes. Because what people used to do? People used to do this buying and selling outside the market. And capital gain used to come, they used to not pay any tax on those capital gains. Because the transactions used to happen outside the market. Now, in case of listed shares, if you will do the transactions on the stock exchange and your gain is there, will charge gain at a very concessional rate of 5%. Now tell me, to save that 5%, which is a very minimum amount of tax, nobody will be taking that much risk. So everyone started doing the transaction on the stock exchange. Understanding? And the government started taking 5% tax. So everyone now shifted to stock exchange. To bring everyone under the radar, that the government is knowing that who is selling, who is buying, what is the gain happening, all these things should be in the eyes of government, which was not happening earlier. This 111A came, and that was a weapon at that time. And very softly, the government first introduced 5%. It is better to charge 5% rather not to have any tax. Because bloody people are selling outside the market, hiding the entire gain, not paying a single rupee of tax. At least they will pay 5%. Why? Because we were charging normal rates. Normal rates were higher, so people were not paying tax. So see, if you will transfer your listed shares to stock exchange by paying STT, will charge very less tax. So everyone got motivated. They became greedy that okay, no, government is charging less tax, let us sell through stock exchange. Only 5% tax is there. No, they were not knowing that later on the government can increase this tax also. And this exact thing happened. After few years, after 5-7 years, this tax rate increased to 10%. And that remained same for few years. Then again that tax rate was increased to, still it is less than your actual tax, normal tax rate. No, we are charging concessional only. First we were charging 5%. Now see, the government expenditure is increasing. No, so to meet that increased expenditure, we have to collect more taxes. So we are charging 10% instead of 5%. But still it is less than your normal tax rate. No, normal tax rate can go up to 30%. Still it is lower, 10% only. After few years, see the expenses are increasing. So we are increasing the tax rate. People started shouting. Why are they shouting? Still it is less than your normal tax rate. Concessional rate only. Getting my point? And last year only, again they increased. Mrs. Sitaman. 20%. Still it is less than your normal tax rate, which can go to 30%. So this is a concessional tax rate which we are offering. But this entire thing started from 1st October 2004 onwards. So if you do the transfer on the recognized stock exchange by paying STT on or after 1st October 2004, meaning if you are transferring right now, that means you are transferring on or after 1st October 2004 only, no? So even if you don't remember this date, that is okay. Understood? So now tell me, now, is it necessary to pay STT at the time of acquisition? No, it is not necessary. So at the time of acquisition, STT may be paid or may not be paid. It is not necessary. But the period of holding should be less than equal to 12 months. Asset is a short-term asset. Hence, the short-term gain will be covered by 111A if this condition is fulfilled. So, I am writing here, STT may or may not be charged on acquisition. It is not a requirement that STT should also be charged at the time of acquisition. It is a requirement at the time of LDCG. Understanding? And that too also only in the case of listed equity shares. Now tell me, here if the shares are acquired, so what will be the cost of acquisition to calculate this capital gain? Simple. Take the actual cost also only. Always take the actual cost. That's it. And that we did in our last question. We calculated the capital gain of bonus shares. What was the period of holding of the bonus share? Less than 12 months. So either the listed equity shares are acquired by you in the form of bonus shares or right shares. Any listed equity shares are there. If the period of holding is less than 12 months and you are transferring through recognized stock exchange by paying STT, the STT paid short-term gain will be taxable at what rate? Flat 20%, at the rate of 20%. To calculate this capital gain, the cost of acquisition, what cost of acquisition you are going to take? Actual cost. Whether the listed equity shares are purchased by you or they are bonus shares or they are right shares. Any type of listed equity shares, you are always going to take what? Actual cost as the cost of acquisition. Understood? Sure, sir? Perfect. Now, today we'll end here. And tomorrow we are going to start with the second part of the chapter. Okay, second part is very interesting. We are going to do the specific charge. Specific charge means specific type of profits and gains which are also taxable under the head capital gain. See, usually the profit or gain arising on transfer of capital asset will be taxable under the head capital gain. So you have a capital asset, you transfer the capital asset, then the profit or gain arising will be taxable under this head in the year in which the capital asset is transferred. But sometimes in special situations also the profit or gain are taxable arising, and those profits or gains are also taxable under the head capital gain. Which are the special situations? Oh, you have received insurance claim on damage or destruction of a capital asset. Because of that receipt of insurance claim also the profit or gain might arise. Even that profit or gain will be taxable under the head capital gain. Even that will be treated as your capital gain income. Oh, capital asset compulsorily acquired. On compulsory acquisition, you are getting compensation. Because of that compensation also, the profit or gain will arise. Even that profit or gain will also be treated as your capital gain only. Oh, you are converting your capital asset into stock in trade. On this conversion also the gain will arise. That gain also we will consider your capital gain only. Specific charge under the head capital gain of certain special type of profit or gain arising in special situations known as specific charge. That we are going to do tomorrow, and tomorrow the second part will be over. We'll enter into the third part of the chapter. Yes or no? And day after tomorrow we'll try to finish as much as we can. Okay? So capital gain 2 more days and the chapter will be over. Okay? See you all tomorrow. Bye bye.